Everybody wants to go commercial. Nobody wants to admit that they're not ready. So today I'm breaking down the actual path from beginner investor to commercial investor. The steps, the skills, the numbers, and the requirements that lenders look at. This is the version without the guru nonsense and without pretending you can buy a 20-unit building with $5,000 and optimism. You always start small. Your first investment property is usually a single-family rental, a duplex, a small BRRR project, or a house hack. First deal teaches you the real skills: collecting rent, dealing with tenants, paying bills, handling repairs, and surviving your first clogged toilet without emotional shutdown. You're learning management, not chasing millions. So after you've survived property number 1, you move on to number 2 or number 3. This is where you build experience, cash flow, credibility, and a track record that lenders actually respect. Because let's be honest, if you can't manage a duplex, you're not going to manage a 24-unit building. Not in this universe. This is where you learn the BRRR or value add game. Buy something undervalued, fix it, raise the rent, and increase the value. This teaches you rehab budgeting, working with contractors, managing timelines, forcing appreciation, and improving NOI, net operating income. This step turns beginners into operators. Now we talk about the cheat code joint ventures. You borrow experience. A JV partner gives you credibility, expertise, deal flow, relationships, and guidance. And yeah, you split equity, but you gain a resume. Think of JV partners like investor training wheels, except you don't look stupid. Once you're leveling up, you need to understand the 5 numbers that decide everything. First, NOI, net operating income. This is the property's income minus operating expenses, not including the mortgage. Second, cap rate. That's your return if you bought the property in cash. Cap rate equals NOI divided by the purchase price. High cap rate usually means higher risk. Low cap rate usually means more stability. Next, pro forma. A pro forma is a projection. Future rents, future expenses, future NOI. It's a wish list, not reality. Experienced investors treat it like a Tinder bio, cute but probably exaggerated. DSCR, debt service coverage ratio. DSCR equals NOI divided by your annual mortgage payments. Lenders want 1.20 or higher. Although if you go with me, you could go all the way below 1. So make that note. Then there's your balance sheet, your assets, liabilities, liquidity, and net worth. This is your financial report card. Commercial lenders care about performance, not feelings. You need 20 to 30% down, strong credit, 6 to 12 months of reserves, clean cash flow, a realistic operating plan, solid NOI, and a DSCR of at least 1 point. And yes, they will look at everything you touch financially. That's called global cash flow. When you have the experience, the partners, the capital, the numbers, and a lender who's not terrified of you, that's when you buy your first commercial asset. It might be a 5 to 12 unit building, a small mixed use, a tiny office, or a retail space, or even a hospitality or storage project. This is when you become a real operator. Commercial is a snowball. You learned underwriting, you learned operations, you build equity, you leverage it into larger deals. Deal by deal, you build a portfolio that pays you long term. This isn't flashy. It's not overnight. It's skills, deals, and scale. If you want a real path without guessing, without blowing up your finances, and without listening to TikTok gurus, call me. I'll tell you exactly what you qualify for and exactly what your next move should be, based on math, not fantasy. I'm Joel, the Mortgage Guide, and I'm working for you. And yes, I can help in all 50 states through my licensed partners. Thank you very much. If you'd want more content like this, hit like, subscribe, and hit the bell for more.